Hello friends, I am Raj Singh. I am MD and CEO of IDBI Mutual Fund. And at the outset, I thank Groww team to provide me opportunities to talk about investment on their wonderful platform. Uh, I will speak in two parts. Firstly, we will speak about the 5 basic rules of investment. And then in the second part, I will talk about my company and the products which we offer. So let's begin with the 5 basic rules of investment. The first and foremost basic rule of investment is start early and invest regularly. That is the first basic rule. Uh, you have to start early. In fact, you have to start from the very first month when you have started a job or you have started generating income, and keep the investment regularly. Then only you will benefit from the power of compounding. And power of compounding is such a wonderful idea that the great genius Einstein used to say that it is the eighth wonder of the world. Let us understand the power of compounding through an example. Uh, there are two brothers, Ram and Syam. They're from the same family. They start a job at the age of 25. And salary for both Ram and Syam is 30,000 each month. Ram thinks that he should start investing from the very first month. And Ram start investing 40% of their corpus, which is 12,000. And he invests only up to 5 years. At the age of 30, he stops investing. Please note, I'm not suggesting to stop investment. This is just for understanding the benefit of power of compounding. You should always regularly invest and invest all the time. So for an example perspective, हम इसको समझते हैं कि वो 5 साल के बाद इन्वेस्टमेंट छोड़ देता है. उसने 12,000 रुपये 5 साल के लिए इन्वेस्ट किए और एक इंडिकेटिव रिटर्न हम लेते हैं 12% उसने जनरेट किया. Can you imagine what will be his corpus after at the time of retirement at the age of 60? His corpus would be 3 crore 60 lakhs. He has just invested 5 years, 12,000 a month with an indicative return of 12%. His corpus would be 3 crore 60 lakhs. Whereas the other brother, Shyam, he thinks at the age of 25 that there is no liability and why should he start investing at such an early age? And he starts partying hard, buying all his stuff, have a credit card, and do all sort of enjoyment. He is doing everything but not investing. Suddenly at the age of 35, he thinks that he is married now, he has 2 kids, he has a lot of liability, so he should also start investing. So at the age of 35, his salary has gone double from 30,000 to 60,000. So he also allocates the same 40%, which is 24,000 a month, which is double of what Ram was investing. And he invests till the age of retirement. So he is investing for 25 years. So double the amount of Ram and 5 times the time horizon he is investing. If we take the same indicative return of 12%, his investment would be still 30% lesser than Syam. Please note, he has invested 5 times of what Syam has invested and double of the amount what Syam has invested. Still, he is less than 30% by Ram. Why Ram is getting benefited? Because he started early. So this is the benefit of power of compounding. Power of compounding works for you only when you start investing at a very early age. So the first advice is that please start investing from the very first months when you have started generating income. The second basic rule of investment is that start regularly for your long-term goals. What are long-term goals? Long-term goals are any goal which is more than 5 years away from today. So buying a house after 10 years, your children's education after 15 years, or anything. It can be different for different people. Anything which is more than 5 years away from here can be a long-term goal. And long-term goals, inflation always works against long-term goals. So you can understand the impact of inflation on long-term goal again by an example. Let's say your child is, say, 3-year old, and he will go for an engineering course after 15 years. Today, the cost of engineering course is, let's say, 15 lakh. And if you take a moderate amount of inflation, after 15 years, this cost will become 35 lakh. So you have to beat inflation in the long term. Uh, and to beat inflation, you have to choose the instruments which can generate much better return than the rate of inflation. And equity is one such asset class which can always beat inflation. So for long-term goals, you must invest through instruments which can beat inflation, and equity only can beat inflation. And you have to start investing regularly. So you have to identify your long-term goal, keep investing regularly through instrument which can beat inflation. Then only you will be able to meet your long-term goals. Third basic rule of investment is differentiate between your short-term goal and long-term goal. Long-term goal we've already spoken about. Short-term goals can be any goal which is less than 5 years old. Maybe after 3 years, you are planning a vacation overseas. That is a short-term goal. Buying a car after 3 years. Anything which is less than 5 years is a short-term goal. Now, while inflation is very important for long-term goals, for short-term goals, certainty of your investment is very important, because your time horizon is limited. So you can't afford volatility. So here, the certainty of the cash flow from investment is very important. For such investments, fixed income products are good. And somebody who can higher risk appetite can use hybrid schemes, which is invested partly in equity and partly in debt. But please note, for hybrid schemes also there will be volatility, but they can generate slightly better return than the debt schemes. So for goals which are, though short term to medium term, where the horizon is 4 to 5 years and you have higher risk appetite, you can also invest in hybrid schemes. So differentiate between short-term goal and long-term goal. For short-term goal, you need certainty of investment and less volatility. So for short-term goals, fixed income products are better. Fourth basic rule of investment is diversification. There is a very old saying, very old proverb, which says that don't put all your eggs in one basket. That is very important lesson and very important for investment. Do not invest in one asset class or one sector. You have to diversify your investment in various asset classes. Now, which are the asset classes which are available for a normal person? There are 4 or 5 asset classes only where you can invest. So real estate is one class. The other class is equity. We've already discussed that equity can beat inflation in long term. So for your long term goals, equity is very optimal. For your short term goals, you have fixed income. Now all the debt, mutual fund debt schemes, your PPF, your fixed deposit, your NSA schemes, small deposit from government, everything comes under fixed income. This is one asset class. Then you have gold. Gold can hedge against any. You can use gold as a hedge against your equity portfolio. So you can have 5 to 10% of your portfolio in gold. So these are major 4 or 5 asset classes where a normal person can invest, and you have to diversify your entire portfolio across these 4 or 5 asset classes. Now, the another thing which is very important for diversification is correlation. So since you have invested in different instruments and different asset classes, does not mean that you have diversified. Correlation plays a very strong role. Correlations means asset classes which behaves in same fashion. Let me give an example. Like if you have invested in index fund, Nifty 50 index fund, which invest in the stocks of Nifty 50, and you have also invested in a mutual fund, sectoral investment fund, banking and financial services. Now, banking and financial services are very high weightage in Nifty. So both are correlated and they will work in some fashion. When the Nifty 50 goes up, most of the time, banking and financial services will go up. When they come down, they will also come down. So though you have invested in two different products, but they are highly correlated and your strategy for diversification will not work here. The other thing which plays a very important role in diversification is risk appetite. Like I have already said that for short-term goal, somebody who has lesser risk appetite should go for fixed income. Somebody who have higher risk appetite can go for hybrid fund. Similarly, within the equity also, somebody who has higher risk appetite, higher time horizon, they can go with mid cap, small cap, or sectoral funds, which can generate high return in longer horizon. But the returns from these will be very, very volatile. They're risky products. So only those who have higher risk appetite should invest in these funds. Somebody who has lesser risk appetite should start with index fund and go with hybrid equity fund or large cap stocks in the equity segment. Similarly, for debt, somebody who has lesser risk appetite should go for a low duration fund. Somebody who has higher duration and also higher risk can go for a long duration fund. It will generate a better return than a short duration fund. So these two things, risk appetite and correlation, important, very correlation and risk appetite plays a very important role in diversification, and diversification is very, very important. Fifth basic rule, and this is one of the most important basic rule, is not to work on tips. Let's say in March, because of Corona, the market was down, and some of your friends, they invested in small cap and large cap stocks, and they have made a killing return of 30%. And now you think that they are investment guru, and you start taking tips from them, and you will find that you will end up with huge losses, or there will be a capital depreciation. So don't don't work on tips. Here I will introduce an idea of area of competence or circle of competence, which is greatly admired by the legendary investor Warren Buffett. What does it mean? It means that you do not invest in anything which you do not understand. Like, till such time you understand the equity market, about the economy, its impact on a stock market, world economy, its impact on Indian stock market, then interest rate, commodity, and how the interplay of commodity and interest rates impact the equity market. Till such time you are thorough about it, you understand the balance sheet of the company, you understand the basic ratios which determines the valuation of a company, don't enter the market. You have to enter the market through mutual funds, and these mutual funds are managed by competent fund managers who have 20-30 years of experience, and then there is a research team which assists them. They do all sort of valuations for stocks, and then they pick stocks, and then they invest. So till such time you increase your area of competence, you should enter the market through mutual fund. And through the years, if you increase your area of competence, circle of competence, you start learning about market, learning about the multiples, valuations, then you can invest uh, part of your portfolio through direct equity. So it is very, very important that do not work on tips which you get from a unprofessional or anybody, Tom, Harry, and Dick. If you want a real assistant, you can always hire a professional financial advisor which can help you in investing. So these are the very 5 basic rules of investment, and if you follow them, I'm sure you will meet all your long-term goals, you will meet all your short-term goals, and you can create wealth for your next generation also. These are the very five basic rules. And one important thing also we should keep in mind while investing is the tax implications. So your financial advisor will always advise you, take help from him, or you can also uh, have your own research with which are the tax efficient instrument which can save you taxes. So tax is also very important in investment this thing. So आप आपका जो इन्वेस्टमेंट मैनेजर है वो आपको एडवाइस कर सकता है. जैसे मान लीजिए कि डेट फंड आफ्टर 3 years you get the indexation benefit. In equity funds you get capital gain, and that is free to some and that is exempted to some extent, whereas in many fixed income product like fixed deposit etc., they are fully part of your taxable income. So you can get benefit of taxation also. If you do not understand it yourself, take the help of a financial advisor. They will advise you which are tax efficient. So along with these five is basic rules and tax implications of the various instruments, you can really uh, create a lot of wealth for yourself, your long-term goals, and you for your inheritance also. Uh, then second thing is, now coming back to IDBI mutual fund, we offer almost all the different asset classes which I have discussed about. In equity, we have 11 schemes. We have large cap scheme, we have mid cap scheme, we have small cap scheme. Then we have sectoral funds on banking and financial services. We have a, a pharma fund. We have hybrid schemes. So for your and then for your short-term goals, we have debt schemes like dynamic bond fund, short-term bond fund, gilt fund. Then you have credit risk fund. For emergency corpus, you have liquid fund. So for short-term goals, you can invest through debt schemes, or somebody who has lesser risk appetite can invest through our debt schemes. Similarly, we have gold also. We have a gold ETF, and so instead of investing through physical gold, you can always invest through the gold ETF. The investment in gold ETF is very, very seamless. In physical gold, you have a lot of risk of theft. Then you have to park the gold in some bank for which you pay something, or there are a lot of risk in carrying physical gold. So by paying a small premium, you can invest in gold through gold ETF, and gold ETF has generated a very decent return in last 1 or 2 years. So you 5 to 10% of your corpus, as I have suggested you earlier, can be invested in gold through gold ETF. So we offer all three asset classes except real estate, which I have discussed about in the one of the basic rules of diversification. So please invest regularly, invest for long term, invest in instruments which can beat inflation, diversify your portfolio, and identify your short-term and long-term goal using tax-efficient instruments. That is the crux of the investment. So, happy investing. Thank you. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.